Your debt-to-income ratio is a key number lenders use to see how much of your monthly income goes toward paying off debts. In the finance world, this is commonly referred to as your DTI ratio. Many mortgage lenders prefer a total debt-to-income ratio of 43% or lower when you apply for a home loan. To calculate this, add up all your recurring monthly debt payments and divide that sum by your gross monthly income before taxes. Lenders often look at two versions. The front end focuses just on housing, while the back end includes every other debt you owe each month. A lower ratio generally indicates you have more breathing room in your budget, which can make you a more attractive candidate to lenders. Remember that this ratio is just one piece of your overall financial picture, alongside your credit score and your savings history. Monitoring your debt-to-income ratio helps you make informed borrowing decisions. Thanks for watching, and stay tuned for more personal finance basics.